Welcome back to Second Level Signals, the series where we look past the headlines to uncover the hidden forces shaping money and power. If you missed our first episode, we explained why China's 4.5 trillion yuan capital flows have now surpassed its trade flows for the first time. That's the foundation. And today we take it one step further. What those flows mean for China's power and its fragility. Last time, we saw China cross a historic line. For the first time ever, financial flows surpassed trade flows. $4.5 trillion in just 7 months. But milestones alone don't tell the full story. Because the very flows that give China more global influence may also expose its deepest vulnerabilities. This isn't the first time Beijing faced a surge in cross-border money. In 2015, a surprise yuan devaluation triggered panic. Within 12 months, over $1 trillion fled the country, the largest capital flight in modern history. China's central bank burned through more than $500 billion in reserves to stabilize markets. It was a reminder, when the doors open, money doesn't just flow in. It can rush out even faster. China is not alone in this dilemma. Look at Japan in the 1980s. After the Plaza Accord in 1985, the yen strengthened sharply. Japan opened further to foreign inflows, and easy money flooded into its stock and real estate markets. By 1989, the Nikkei had tripled and land prices were soaring. But when the bubble burst in the early 1990s, banks were left with mountains of bad debt. The result was a lost decade of stagnation. The lesson for China is clear. Inflows boost prestige and asset values, but they also risk creating bubbles that unwind painfully. Or take South Korea in 1997. Before the Asian financial crisis, Korea still had capital controls. Ordinary savers couldn't freely move money abroad, but banks borrowed heavily from foreign lenders. When confidence collapsed, that money rushed out overnight. Korea's reserves dried up, and the IMF stepped in with a bailout. The price of rescue was full liberalization. After 1997, Korea tore down many of its capital controls. Foreigners could buy stocks and bonds more freely, and Korean money could leave more easily too. Korea survived and modernized. But the lesson was clear. Once you open under crisis, you never fully close the door again. China today stands between these two paths. Not fully open like Japan, but not closed off like Korea before 1997. Here's the second level signal. Openness brings prestige. More yuan in global reserves, more Chinese bonds in pension funds, more weight in global indexes. But it also creates paradoxes Beijing can't escape. Control versus global role. The yuan can't become a true reserve currency without loosening capital controls. Yet loosening those controls weakens Beijing's grip. Savers versus system. With $23 trillion in deposits, Chinese households want diversification. If outflow channels expand, domestic capital may leave even faster than foreign capital arrives. Bubbles versus crashes. Inflows inflate asset markets. Outflows accelerate downturns. The cycle gets more violent as doors widen. For investors outside China, this isn't abstract. It's about volatility spreading across borders. If China liberalizes too fast, outflows could hit global markets like a financial shockwave. If it stays too closed, the yuan never rivals the dollar or euro. Either way, $4.5 trillion moving in and out of China is no longer a local story. It shapes bond markets, reserve decisions, and risk premiums worldwide. This is second-level signals, where we test not just the milestones but the fragilities beneath them. China's 4.5 trillion flows mark a historic shift. But the question is no longer just factory or finance. It's, can China hold power without losing control? And if you missed our first episode, we broke down why China's 4.5 trillion in capital flows have now surpassed its trade flows for the first time. That video sets the stage for today's discussion, and you'll find the link in the description so you can catch up. If you've watched this far, we hope this video gave you something useful. Our channel covers a wide range of macro topics you may find valuable. So please subscribe and hit the bell, then choose all notifications. That way, you control what you want to watch, not the algorithm.